Welcome to The Explainer. Today we're pulling back the curtain on the Forex market to look at a hidden game that plays out every single day right under our noses.
So, let's start with the feeling that I'm sure every trader knows all too well. You do your homework, you place your trade, you set a perfectly logical stop loss, and then, boom. Price whips down, takes you out, and then immediately reverses and flies in the direction you predicted. It's maddening, right? But what if I told you that's not bad luck? What if it's not random at all, but actually part of a deliberate, predictable system? Well, that's the core idea behind the market maker method. It's all about a hunt for one thing: liquidity.
So, over the next few minutes, we're going to break this all down. We'll look at the players, the main tactic they use, the clues they leave behind, why timing is so critical, and of course, what this all means for you and how you can start looking at the market in a totally new way.
All right, let's dive right in. To understand the game, you first have to understand the players. And really, it just boils down to two sides with completely opposite goals. So on one side, you have the institutions, the big banks, the hedge funds. These are the hunters. See, they need to move huge amounts of money, but they can't just smash the buy button. To fill their giant orders, they need liquidity. And where do they find it? Well, that brings us to the other side, the hunted. That's the retail market. That's us. All of our stop-loss orders, clustered together, create these perfect, predictable little pools of liquidity that are just sitting there waiting to be collected.
Okay, so how exactly do these big institutions go about hunting for that liquidity? Well, it's not some big mystery. It's a specific, repeatable move. Let's get into the core tactic they use.
This is their number one weapon, the stop hunt. You might also hear it called a Judas swing. It's a sharp, sudden price move that looks totally random, but it has a very, very specific purpose: to smash through those clusters of stops, grab all that liquidity, and use it as fuel for the real move they wanted to make all along.
And this breaks down exactly how it works. First, the market makers create a really obvious level, a nice, clean high or low that everybody sees. Then, just as you'd expect, retail traders start placing their stops just on the other side of it. And then comes the move. A sudden, engineered spike that sweeps right through that area, triggering all those stops. Once those orders are filled and the liquidity is theirs, the trap snaps shut and the price reverses aggressively, leaving everyone who just got stopped out in the dust.
So this is the big mental shift you have to make. Instead of just asking, where do I think the price is going to go, you need to start asking, where are all the stops? Because that's where the money is, and that's where the big players are going to push the price.
Okay, so if these big institutions are making these massive moves, they have to leave some evidence behind, right? You can't move that much money without leaving tracks. And you're absolutely right. So let's talk about how to find their footprints on the chart. And these clues are called order blocks. The easiest way to think of an order block is as a footprint. It's the very last point where the big money was loading up their positions right before they launched a huge move. It's literally a block of orders that leaves a signature on the chart, and what's so cool is that the market often comes back to test that exact same level later on. And there are two main types, which is pretty straightforward. A bullish order block is simply the last down candle right before a big push up. That area becomes a potential spot for future support. And you guessed it, a bearish order block is the opposite. It's the last up candle right before a major drop, and that becomes a potential resistance zone.
Now, not all order blocks are created equal. The ones you really want to pay attention to, the high probability ones, usually have a few things in common. They show up at major swing highs or lows. They're created by a really obvious stop hunt which confirms institutions were at play. They often line up perfectly with key Fibonacci levels. And, crucially, they're much more powerful when you find them on higher time frames, like the 4-hour or the daily, because that signals a much bigger institutional commitment.
All right, another huge piece of this puzzle is the timing. You have to understand these institutional moves aren't random. They happen at very specific, predictable times of the day and even specific days of the week.
See, pro traders aren't sitting there staring at charts 24/7. They wait for what they call kill zones. The London Open, for example, is famous for stop hunts that set the high or low of the day. Then the New York Open often either continues that move or reverses it entirely. And the Asian session, a lot of times, it's just quietly building up the range and the liquidity that's going to get attacked once London opens.
And this rhythm doesn't just happen every day. There's also a weekly pattern to look out for.
So often, the market uses Monday to just set the stage and accumulate orders. But then, the real action happens. Very frequently, the actual high or low for the entire week is formed on a Tuesday or Wednesday. That's when you'll often see the major reversal happen, which then sets the trend for the rest of the week.
So after all that, what's the big takeaway here? How does knowing about the players, the tactics, and the timing actually change anything for you when you're looking at a chart?
Well, the goal is to completely shift your mindset. You have to stop chasing what looks like a breakout, because now you know it might be a trap. Instead, you start anticipating where the liquidity is building and where the institutions are likely to strike. It's about going from being the hunted to thinking like the hunter. It's seeing the market for what it is, not a random mess, but a structured cycle of accumulation and distribution.
And this might be the toughest part of it all, letting go of the need to be right all the time. The source material calls this the trap of control. This idea that you can find some perfect system that never loses. The truth is, you can't. The real breakthrough happens when you accept that uncertainty and just start thinking in terms of probabilities. So, ultimately, when you understand this framework, you're not just looking at lines and candles on a chart anymore. You're reading a story. It's a story of institutional intent, of liquidity hunts, and carefully planned moves. The footprints are all there. The real question is, now that you can see them, can you use them to avoid the hunt?